Hello, everybody. Welcome to TraderMerlin Show. It is your Monday edition, a rip, rock, and roaring Monday for those of you who might be watching these equity markets. Of course, even crude oil taking a monster launch to the upside, which is great to have those types of moves on a day like today because, as you guys may have seen from the marketing stuff I put out on Twitter and on Facebook, we're going to have none other than Scott McCormick. He's a charter market technician. He does a thing called the BECC report, which is bonds, equities, currencies, and commodities, which gives him a perspective on what on earth is going on in these financial markets. So without further ado, welcome to the show, Mr. McCormick. How you been?
Hi, Marilyn. I'm fine. How are you?
Fantastic. I'm glad to have you back with me. I looked at the last time on the Skype call. It's been 3 months. I'm a little disappointed that I can only get you on here once every 3 months, but I'll take what I can get.
Once a quarter isn't bad. It's, you know.
It's like an earnings announcement.
Exactly.
Last time you were on the program, we were talking about more of the same. Things really didn't look like they had changed. Obviously, everything seems to have changed recently, from elected officials to political presidents to the drama. Well, the drama's not going to change. We've also seen some pretty big moves in different currencies and commodities. I don't know where you want to get started. Maybe we should start with the overall indexes and see what your perspective is there, because there's been some, huge divergences today with those indexes.
It's funny when you say, let's kind of get started, and that's kind of the entire picture or idea with the BECC report is that I have a very specific place where I start, and it's always beginning with looking at the asset classes versus one another. So I try to approach it from the perspective of building a portfolio. And if you're looking at a portfolio, you have to determine first, should I be in bonds? Should I be in stocks? Should I be in commodities, currencies? If it's a combination, what's my mix? Meaning, should I be 60% stocks, 40% bonds, or vice versa? So I always one of the tools that I always use, and I love using, it works very nicely, is the relative strength ratio analysis, which is very different than a relative strength index. It's not an indicator for an individual security, but it's a comparison between two different types of securities, and depending upon the analysis that you're looking to conduct, you can do asset class to asset class, sector to sector, stock to sector, or even stock to stock. And so, when I approach the BECC report, I look at all of the asset classes first. So I'm looking at small cap versus large cap stocks. I'm looking at international versus domestic stocks, bonds versus stocks. I'm looking at gold versus stocks to get a sense as to where we might be in the big picture. And probably one of the biggest things that I'm noticing here of late is that in terms of the bond to stock relationship, stocks are actually outperforming bonds, which should be fairly bullish for the equity markets. And obviously we saw some a great deal of strength of bonds versus stocks in the beginning of the year, but that's to be expected when you have a panic like we did. But it seems to be trending back in the other direction now. So stocks are outperforming bonds, but within that, and this is probably one of the biggest shifts that I've seen over the course of the last year and a half, is that small cap stocks are finally starting to show some strength versus large cap stocks. Now, the reason why that's so significant is that there's an old adage out there that small cap stocks leading going into a bull market and small cap stocks lead going into a bear market. And so seeing this relative strength in small caps versus large caps is actually quite bullish right now, which I know for a lot of listeners out there, they might seem a little confused by that statement, because it's like, dude, we've been in a bull market for the last 10 years. And to an extent that is true, but there's also been this large corrective activity within a lot of your broad market indexes for about the last year and a half, almost 2 years. If we, for instance, were to look at a monthly chart of the S&P 500, and I think that's probably one of the important things for your listeners to understand about what I do, what I look at when I'm doing the BECC report. I'm usually looking at weekly and monthly charts. So whenever I do my relative strength analysis, I typically prefer to look at weekly charts. If I need to get bigger picture perspective, I'll go out to the monthly chart. But as I begin to analyze the individual components, so when I actually go in and look at the equity indexes, or I look at the treasuries, or if I look at commodities and start to go into the specific markets, I like to use monthly charts because it filters out all of the noise that we tend to see in the short term. You were talking about all of the changes that we've seen, the drama that we've heard. That gets reflected very quickly and easily in your daily charts, and even for those day traders out there. I mean, you see it very easily in those intraday charts, but you start to get out to the monthly charts and things get kind of quiet. They help you to kind of filter out, mute all of that noise, and focus on what the big picture is. But if you were to look at those monthly charts for like the Russell 2000, the Dow Jones Industrial Average, even the S&P 500, all of this activity has been corrective in nature. And normally what I do is when I approach the markets from a longer term perspective, my attention is generally drawn to the cash index for the S&P 500 and the cash index for the Russell 2000. Mostly because those two indexes are the indexes that a majority of your institutional money is benchmarked to. When you look at the stock market, the biggest owner of stocks is going to be mutual funds, and so mutual funds are typically broken down into large cap and small cap, asset class groups. So those two indexes being really kind of the proxy that these or the indexes rather, not necessarily the proxy, but the indexes that these mutual funds are trying to follow. So it's really important to me to kind of get a sense as to what the institutional money is doing from a longer term perspective by looking at these things. The S&P 500 has this conical shape over the course since about 2018, early 2018. From that high, I mean, you can almost draw a line connecting the highs from 2018 to the highs in 2020. And then, of course, the lows there from late 2018 to the low in, early 2020. And you just have this megaphone type formation. Again, that's corrective in nature. So even though we actually made another all-time high today, it's very choppy. But that choppiness would be expected within a corrective environment. And so seeing this relative strength actually start to rear its head in the Russell 2000, I think is fairly bullish. And we might actually start to see that we get out of this choppy environment and return to more of a trending environment, much like what we saw during like the 2011 through 15 and the 2016 up through 2018 for most of these indexes.
When we look at this, so I drew out your megaphone kind of formation. Some would call it a broadening formation, et cetera. A couple different things. When I look at the shape of this, obviously there's the prevailing trend, which is undeniable. It's just been ridiculously strong. And by the way, guys, this is the S&P futures I'm looking at here, not the cash index. In a formation like this, and I know you're the CMT, I am nowhere near that level of nerdiness and understanding of technical stuff, but when I look at this pattern, to me, it begs a question. Are we maybe in a melt-up phase? I know a lot of people are feeling we're in this melt-up phase. Certainly last week's rally and starting off today on such a good footing, it didn't end that way, but at least it felt like kind of a melt-up phase. What's your take on this pattern continuing on? Because we are right at the upper trend part of this piece. To me, you've got you're overextended a little bit and potentially can have a retracement. If we do, then do we challenge that lower trend line? And I mean, goodness gracious, that puts the S&P at 2,000. It would take a lot of crazy events, but isn't that the nature of patterns? Is looking for those types of irrational sell-offs?
It is, and when I see this broadening top, it definitely made me very nervous because if this broadening top were to continue, it is indicative of volatility. And when you take a look at probably one of the only other times that I've seen in history for the S&P 500 cash index where this has happened, you have to go back to the period of 1966 to when we actually kind of broke out of the entire range going into mid 1980s. So that was a 14-year period where that correction actually kind of unfolded. But what was interesting about this is that, if we were to use that period of 1966 through 1980 as an analog, meaning that we actually see the same type of formation unfold now in terms of symmetry, meaning the same number of highs, the same number of lows. We're making that third high right now, which is the same number of highs that we made, but back in the 60s going into the mid 70s. And it was that last high going into late 72, early 73 that preceded one of the biggest sell-offs that we saw in the S&P 500 at that point in time since the 1940s. And so, during that period, it was about a 50% decline versus that 1973 high down to the 1974 low. And then from there, we saw a pretty nice move up, but it wasn't until we actually broke out to a new monthly high on in September, October of 1980, where we really kind of saw the continuation or the confirmation, if you will, of that multi-decade bull market that unfolded from the early 80s going up into the early 2000s there before we really started that big sideways range again. So it is very possible, and if that were the case, if we actually saw a 50% decline from where we are right now, then I would expect to see the S&P 500 easily get down to about 1,800. But what's also interesting about that area is that there is a level of support in the S&P 500 from back in that range-bound sideways environment that we saw in 2015, 2016, between that 2125 to about the 1,800 area. So I wouldn't be surprised to see a test of that. But the funny thing about patterns is that whenever everybody sees the same pattern and they start talking about it, usually it doesn't unfold.
Right.
I recall specifically going into July of 2009 and having a conversation with another broker's client. So in my old office that I worked in, we had about 12 different financial consultants, and anytime anybody ever had like a question that was more technical in nature, they would usually call me in. And I just remember this one conversation in particular where this client laid out a very specific strategy that they were going to use to take advantage of the daily head and shoulders pattern that they were seeing in the S&P 500 to try and get short. And I worked them through that, and I confirmed all of their levels and all of their numbers. But I also remember specifically disclaiming the fact that, one, we're having this conversation, two, everybody else is looking at this, chances are it's not going to work. And that was one instance of many, but we saw from the summer of that, and actually it wasn't 2009, it was summer of 2010. No, it had been 2009, I'm sorry, because I left 3 months later. But from there, the market ended up making some new highs and obviously, continued its monthly uptrend. But so I think that over the course of the next couple of months, like the areas that would more or less confirm this, and this is what's really kind of important for your listeners to understand, is that one of my approaches is that I try not to lead into my analysis with any bias. It's like I see this pattern here, and I realize that there's the potential for the market to sell off, but I also realize that in order for it to sell off, it has to sell off.
Yeah.
So I try to identify those short-term levels to confirm that, okay, the market is now trading below this. The probability of that pattern coming to fruition or completion is now higher than not. So this kind of sideways price action that we've seen for the S&P 500 here over the course of the last 2.5-3 months now is going to be pretty key. If we can get a monthly close above the highs from September, which took place in the very beginning of the month, then I would say that pattern is more likely to fail. But if we were to get a monthly close below the September lows, then I would say that chances are we're going to see a sell-off over the course of the next 12 months that could potentially, and maybe 12 to 18 months, that could potentially complete that pattern, because there's no real support there on the S&P 500 until you get much lower, as we already mentioned. So, so I think anytime you see these patterns, it's really important, because today, for instance, anybody looking at a daily chart of the cash indexes, they're going to see a bunch of shooting stars.
Yep.
And that's, that is exactly what that pattern is. But in order for that pattern to become a shooting star, to confirm it, we have to trade down below today's lows, tomorrow's, and actually see a lower close to suggest that, we're more likely to correct the price action from the last week. So there's a lot of factors that go into it, but one of my things is trust but verify. So right. Verification comes in the form of price confirmation.
Yeah, one of the challenges I see with that is especially from the longer term perspective, you're looking at things on a monthly basis, and to wait for so long for that monthly close. You made a good point with the S&P, the cash index right now. That candle right now, I would argue it's not even a shooting star anymore. That's like a giant comet. That's Halley's comet there with this monster tail. I mean, especially when you consider that we're only 9 days into the trading month. I mean, that's like, wow, that's a hell of the range is just colossal. By the end of this month, we could be at 3,500, and to me, that's no longer a shooting star. I mean, it would be mute point. So, part of the challenge for me as a longer term investor is having the patience to wait for this stuff to come to fruition. And that's one thing I really appreciate about you is you're very patient. So I couldn't sit there and wait for all this stuff to happen. I tend to jump in sometimes a little bit too early, and I'll get smoked every now and again. But we all have to know our weaknesses, and that's definitely one of mine.
And I think it's also important for anybody listening to this to understand that I'm using those monthly candles not necessarily as my entry time frames, but as my framework. Because every morning now with Online Trading Academy, our mastermind students from Monday through Thursday, and all students that are XLT or mastermind have access to what's called a GPS session. It's your guided practice session, and basically what we do every day is I'll spend about the first 15 to 20, sometimes 30 minutes. I get a little long-winded sometimes.
No.
But yeah, I know, right? It's Scott. He's not
we love it.
Dude,
honestly, your long-windedness is like, there's some people that go long-winded and you're like, for the love of God, will you stop freaking talking? And then there's people like you where you're like, don't stop. Don't, I don't interrupt you because I'm getting good content. So we love your long-windedness.
Yeah, well, I appreciate that. Just don't ask me to tell a story or a joke. It's either going to be really long and boring or really punny. So, but one of the things that we do in that session is that every morning I'm providing, a framework on a daily basis, Tuesday through Friday. But the first, on Mondays, I'll give a weekly perspective. And last Monday, I changed it up a little bit. I gave a monthly perspective, and you brought up something that a student commented on, and which was, they basically put into the chat that, look, I'm very short term. If I have to wait a month for this thing, I'm going to miss the move. And so what's really important to understand is that we're putting this into context. So, prior to this week's price action, this price from this past week, I should say, we were within this trading range of the S&P 500, for instance, between 35 to 3,200, let's say, just for round numbers.
Yep.
And so looking at that daily price action, we were trading down towards the lower end of that range. But understanding that monthly trend is still up, and that the sideways price action was corrective in nature and not impulsive, would suggest that anybody that is looking at opportunities, you're trading at the lower end of this range. So right. Let's go out there and start looking for some bullish candle reversal patterns. So for instance, you had a failed bullish Harami from October 29th, but then you started to get something that was a little more of a hammer type formation, if you will, with more of an upper shadow on October 30th. But then on November 2nd, you actually had a high close versus the prior trading session. And then on that Wednesday morning, you had a gap up above the range. So, if anything, that was a confirmation on Wednesday morning of a potential buying opportunity. But again, understanding where that is within the context of that bigger picture would help you, one, define, the probability of that trade. Two, it would help you define your risk. Three, of course, help you figure out, what type of reward opportunity there is. Because the funny thing is that when you do any type of measured move analysis, you're gonna be flabbergasted by this probably. If the 2018, 19, and even 2020 price action so far has been corrective, that would actually suggest that the price action from the lows of 2009 going to the highs in early 2018 would be more of your impulsive move. And when you project that price action from the lows there in 2020, assuming for a moment that that is the lower end of your correction and that, that correction terminates, a 100% projection actually puts the S&P 500 at 4,421. Versus where we are right now, that's actually not very far away.
Right.
As you start to project that out in percentage terms versus where we are right now, that's only another 18%.
We hit that on Friday.
The
way we're moving, I mean, shit, we had
this rate.
The Russell was up over 8% today. I mean, come on.
Yeah. It was so this morning when I was writing the daily market overview, when I started, it was up like maybe 1.25%, but then that news announcement came out. Like maybe not even 2 minutes into me writing this, I'm like, okay, well, I got to start over. They were almost all up like 4.5%, 5%. And then by 7 o'clock Central, 8 Eastern, the Russell was limit up. And then, of course, we had the open and it paused. The circuit breaker kind of paused for a little bit, but then it was up, I think, like almost 8.5%, almost 9% at one point, before we started to see the retracement. And I think that's another little bit there, which is important for anybody looking at the markets ever. There's always two phases. You have an impulse and a correction. Well, if the bigger picture trend is up and we've seen this upward price action for the last 5 or 6 trading sessions now, I wouldn't be surprised to see a correction, because that was a very quick, sharp move. There were very little retracements to give any institutions a secondary opportunity to try and join this. And I do think, this is my opinion at least, that anybody that was also trying to get short here today, or short overall over the course of the last few weeks, last 2 months almost, I wouldn't be surprised that a lot of stops were touched off today. When you see this type of price activity where the markets go up very quickly but then start to fade away, there's no big buyers coming in at those higher prices. It's all short covering through stops getting hit. So now is going to be the tell. We obviously had this big gap from Friday, and there's a little area basing there that could potentially provide some support. But if that doesn't hold, then I wouldn't be surprised to see the S&P 500 come back down to where this move started last week, about that 3,300 to 3,250 area, 3,230 area.
Yeah, been some great moves out there, and we've got these lines drawn on here. I've been trying to follow along and draw the pictures as you describe them. The big outlier today for me anyway was that Russell 2000 up so much. I bought some puts on Russell and NASDAQ. Actually, it was perfect how these ran into just all-time high supply zones. If you look at, let me go back here to the at NQ, so you guys can see kind of where these things ran. I go to a daily. The NASDAQ came into the dead highs from September of this year, just briefly, and it came right into an area. I'm like, all right, well, this is fine. We'll buy some puts on that bad boy. Sorry, not at the time. It was the futures contract, but that's just simple supply and demand stuff. And while we could still rip higher, we could make all-time highs. Right now, it seems like everyone's throwing, I want to say, caution to the wind and saying, hey, you know what? Trump's out of the way. We got Biden in place. It seems like this over euphoria right now, and certainly there's a lot of headwinds and challenges we need to figure out with the new president. We'll figure out how that all goes. But I agree. I think you're going to see a little correction here. Maybe not down to that 3,000 mark, but certainly a correction in these markets. Yeah,
and it's from a longer term perspective, one of the other things that I have noticed here of late is that we're starting to see more relative strength in industrials and materials. Materials have actually been one of the best performing sectors over the last 6 months. Industrials are really starting to kind of show their hand a little bit more over the course of the last month and a half in terms of continuation of this relative strength that we've seen since the rebound in the first quarter. But this is typically indicative of longer term sector rotation that takes place throughout an economic and market cycle. Mm-hmm. So I would say that over the course of the next, let's say 9 to 12 months, it's going to be very interesting to see how this unfolds, because prior to this happening, technology and consumer discretionary, those have really been like your leading sectors. And today, as you pointed out, NASDAQ had a very tough day. At one point, The Dow was up 4.5%, 5% almost, yet the Nasdaq was slightly into negative territory, and obviously it closed in negative territory by almost 2% on the futures, and about 2.16 there on the Nasdaq to the downside. So the question is going to be, do we see a continuation in the outperformance of technology, or do we start to see a little bit more of a rotation? And the reason why that's going to be important is because when you look at the S&P 500 as a whole, 27% of that index is represented by technology.
Yeah.
Now, the next biggest sector is healthcare. And, so kind of going into the elections and the implication of having a new president, healthcare is going to be a big fight because Trump might be out, Biden might be in. Obviously, Biden's not going to pursue an ACA policy, but if anybody else does, we do now have a Supreme Court that could potentially knock it out. So one of the things that I would encourage listeners to do is pay very close attention to the XLV, which is the healthcare sector. If we start to see a greater deal of outperformance there in healthcare, it could help transition and carry this market higher. But I would also continue to look to see, do we see strength out of industrials and materials? Industrials still a fairly heavy weight inside of the S&P 500 compared to materials. But one of the other places that I would also be watching is financials, because financials have actually shown a little bit of equal performance with the S&P 500 here over the course of the last couple of months. But it's finally starting to show a little bit of strength here as of today. So if we can manage to get some relative strength coming out of financials, that can help bolster the S&P 500, even if we see XLK actually come down off of its highs a little bit more.
We talked about, we've done a couple different shows on the election and kind of the impacts of it, and two areas that I was pretty bullish on. One, three if Biden was elected, and that would be number one was obviously clean energy, which has had that big rally already. The other one was cannabis, which for those of you who didn't see today, we had huge moves in some of these cannabis stocks, even though the earnings were not that great. You had Canopy Growth reported phenomenal earnings, up 167 or 69% on the earnings announcement. Tilray and Aurora not doing so good, but price-wise, they still vaulted. I think those will be good ones. And the third one was banks. One of the main reasons, in my opinion, is you have a steepening of the yield curve because the Treasury is selling so many bond products that the yields are going to start to rise. Higher yields mean banks are going to make more money. So to me, it's logical. They've been beaten down for a while, and here you go. Bank stocks may be your next nice little move up.
It's funny that you mentioned interest rates, because one of the other things that I took note of was that the interest rates for the 30-year and the 10-year have actually been moving up quite solidly for the last couple of months.
Yeah.
And looking at the interest rate for the 30-year, I've got targets on that between 2.1 to 2.4%, which I know doesn't sound like a lot, but that's going from about 1.75 on the 30-year. On the 10-year, I have interest rate targets in at around 2.4%, which versus the 0.95% right now. That's quite significant. The other thing that I do when I'm looking at the BECC report is that I'll look through the relative strength analysis of the asset classes, but I'll go down into the sectors, but I also take a look at the bond market. And in the bond market, when I do this analysis, I'll compare all the major kind of groups of bonds to the AGG, which is the aggregate bond index. But I'm starting to see that government treasuries, both long-term, so your 20-year plus, your 7 to 10-year intermediate maturities, those are actually starting to show signs of relative weakness versus the AGG. And all throughout 19 and 20 up to this point, they were actually outperforming. Now you're starting to see outperformance coming from MUB, which are municipals. But I think more importantly, and this is probably going to help kind of sway me a little bit more on the bullish side about how all this price action that we talked about earlier, how it resolves on the S&P 500. J&K, which are high yield corporate bond funds, are actually outperforming the AGG and are finally starting to show strength versus the LQD, which is your corporate bond funds, which tend to be a little bit more conservative. So, those are more of your investment grade versus your C or below. And so that generally happens more when you see high yield bonds outperforming your investment grade, that generally happens more so in a bull market environment. So seeing bullish relative strength out of the small cap versus large cap, seeing the JNK or your high yield outperforming, these are actually some positive signs. Now, keep in mind, and this is a note for your listeners, that those comments are really designed to help you understand what I'm thinking about over the course of the next 9 to 12 months, not the next 9 to 12 trading days, because as we stated earlier, that's all kind of noise compared to the long term.
Yeah, and that is important to understand the different considerations of trading styles and how long you can be in things. What else? I had a question all lined up for you, and I got to figure out where I was going to go with my question. Sometimes my mind tends to drift like that. With regards to the dollar, I'm sure you've been checking that out. We saw, for 3 days last week, a really aggressive sell-off in the dollar. I'll bring that chart up for the viewers. But even though it was a super aggressive sell-off, it just came right back down into the base of this channeling that we've seen since, mid to late July. What's your thoughts on the dollar impact here?
So when, again, looking at this from the perspective of the monthly chart, what I see is that we're in this larger sideways range in the dollar between, on the high side, about that 103 area down to about 88. And you're right. Over the course of the last 4 weeks, we've been in this really tight range between, let's call it 95 and 91. And we are towards the lower end of that. What I would expect is that if the monthly trend is really sideways here in the bigger picture, I would expect the dollar to break out to the downside. I have a target in and around 87 on the dollar, which would coincide with that area of basing back in February, first quarter, let's say, of 2018. But should that fail, I wouldn't be surprised to see the dollar actually come all the way back down and retrace that let's call it bull market from 15 to 17, 15 to 18, have a secondary target at 81.50. So the interesting thing, though, is that if you do look at dollar performance during Democratic versus Republican administrations, historically, the dollar tends to do better during Democratic administrations versus Republican. But what was interesting about the Trump administration is that the dollar actually saw a little bit more strength during that 4-year period than I would have expected. Obviously, a little bit more choppy, but certainly not a downtrend like we saw, for instance, during the Bush administration. So it is going to be interesting over the course of the next 4 years to see how this unfolds. Obviously, trade is going to play a big part into that, not to mention the monetary policy that we carry here in the United States. But we have to remember that that's also relative to what's happening overseas, too. So, when we start to talk about bigger implications, we had a very important announcement this morning in regard to possible vaccine. That is going to have some very significant global implications for economies and monetary policy. So if we can actually see that, one, that vaccine does prove to be as effective as what they said, two, they can actually get it out sooner rather than later, we can start to see these global economies come back together again. The central banks are probably going to have to start changing some of their policies and tightening a little bit, to make sure that we don't get too overheated. So
I gotta play devil's advocate here. Just put on my skeptic hat. If we look at whether you believe COVID is this massive, Spanish flu, Black Plague thing, or it's just a hoax, is irrelevant. Bottom line is worlds are responding to it. Economies are shutting down. They're quarantining, making you wear masks, can't travel. Businesses have to shut down. It's kind of crazy. If there is a vaccine that would alleviate all of that, and Pfizer says it's 90%, in the patients. Of course, the other 10% have all died. I'm just kidding. I'm making that up. But the side effects are probably going to be off the charts. But who knows for a period of years. To me, if you came out with something that was that significant, that was that groundbreaking and could allow the world to return back to a normalcy that we're used to, there's no way on earth that Pfizer's chart should look like this. right? It closed at, I'm going to call it 36 and a quarter on Friday, and it jumped at a pretty big jump today, right? It jumped all the way up to a high of $41.99. I call it $42. But look at this thing on a monthly time frame. If they really came up with a cure for something as devastating as COVID has been for our markets, this thing should be like $150, $200, isn't it? Am I crazy?
I don't. Yeah, no, you're not crazy. You're not crazy.
I am crazy, but that's
it's. I mean, I don't know that it would get there in one day.
Yeah.
And let's say, for instance, that even 50% of your population is going to be
taking the
exposed to this virus, and 100% of the global population is vaccinated. The rate at which the vaccines actually take place, I think, would actually be more of an influence on how that stock price is going to kind of perform over the next year. Now, it is important to note that when you do look at Pfizer, I mean, it's really been in this consolidation phase, since the beginning of the year. Obviously, it's rebounded like most other stocks from its March lows. But from a monthly perspective, on a technical perspective, I would say that if you actually get a monthly close above its January high, that's probably going to be a little bit more bullish. But I would expect to see that coincide more so when we see these things roll out, when some of the first vaccines are actually administered to the general population, let's say, before we really start to kind of get too excited. And the reason why is, we live in a culture right now where our society is, unfortunately looking at conspiracy theories, and there's a lot of people that are, skeptical about vaccines, and I saw a joke this morning about so this is when 25% of the population will turn into zombies. This is how the zombie apocalypse starts.
How it starts.
That's just kind of the humor that's out there right now. But I think that humor, the funny thing about humor is that the funniest things are true.
Yeah, there's some basis on truth. Yep.
Right. I mean, it reflects what people believe, and so I think that from all of these developments that we've had, whether it's political or geopolitical, the significance of this vaccine being created and released to the public, time will tell.
Yeah.
And I think that is really going to be the biggest piece in order to kind of lift the veil from a lot of people's eyes and kind of start to change their opinions and their beliefs, because those things don't change overnight.
Yeah.
But yeah, I would expect that, it was nice to see the move this morning that it did, because a 10% move in one day is a pretty significant move. But I think, to your point, though, there's been other pharmaceutical stocks and biotech stocks out there in the past that have had, announcements that were less significant than this, that cause a rise in the price of their stock by 20 to 50% overnight, let alone 10.
Biogen just last week, I mean, they went from 250 to 360 on an announcement of a drug. Okay, it was important, but this is one, to me, that this would be groundbreaking for us all to get back to work. And I'm looking at Pfizer going, that doesn't look right. By the way, this COVID anti-vax or vaccine for COVID is put out by the Umbrella Corporation, just in case you wanted to know. Anybody get the joke on that one? Hopefully you guys got that one. You ever watch Resident Evil?
No. Oh. So that went over my head.
Right over. Well, if you get a chance, you want to watch a good zombie flick. It's a big chain of series with Mila Jovovich, but the Umbrella Corporation basically creates this vaccine. And anyway, it's all coming far too close to home with these vaccine stuff. All right, let's go to. Oh yeah, by the way, Luis. I haven't even looked at that one. I have to look at this real quick. Luis in chat says, "So no more Kodak, huh?" Let's go KODK. Let's see if they're going BK. Oh, they're at $6 still. Hey, you know what? It's still a 200% gain over what it was trading before they got the announcement that they were going to make a vaccine. Just the stupidity of people sometimes. Anyway, all right. You mentioned something earlier. You talked about doing a whole bunch of different sessions. I thought I'd talk about that. And you, by the way, I know you're probably not reading the chat, but you had some nice feedback here. Chris Morris says, Scott, your daily market review and the GPS sessions is so incredibly thorough, such a wealth of knowledge, and that was echoed by a couple of other people here. So you're obviously doing a great job in those sessions. Tell me a little bit about those sessions. Cool, I know there's some rotation in there as well.
Yeah, my focus every day is to, as I stated, is to provide a framework to the markets. Because I think it's important for any participant to understand, not only trend direction but also phase.
Mm-hmm.
Because even if the trend is up and we're in a corrected phase like we were in the mid to late part of October. Yeah, you can go counter trend. You can go short during that period of time, but you've got to have an understanding as to where that correction might end. Because when you switch to an impulse, it's very possible you could see price action like what we saw last week. And if you're trying to, one, take advantage of opportunities, or worse, having to cover shorts during that, you're not going to get the price that you really want.
Right.
But once I kind of cover my piece, once I go through the framework, I talk about the economic announcements that are coming up, the earnings announcements that are coming up. It's usually kind of passed off to, one of 3 or 4 other instructors. So usually in each session, there's 2 instructors. It would be myself and either Brock Pierce or Jeff Manson, Brandon Wendell, or Bashir Shaya. And their focus is to go through and actually look at individual setups for more intraday to kind of swing trade opportunities on stocks, futures, some spot forex. Every once in a while, there'll be an options play that is thrown in there. So it's been kind of a unique offering for a lot of our students here, because we've had variations of it for over a year. But now since I think late July, August, I've been a pretty consistent part there. We're in there every day unless the market's closed. And from, I think it's like 8 a.m. Eastern until 9 a.m. Eastern. So that full hour before the market's open, we give students the opportunity to go through, see where the market is, see, what the potential setups might be. And hopefully, even if they don't take the setups, at least provide them some context about what's happening and help them determine whether or not today is more of a bullish or a bearish day for them if they're day traders.
Nice. Well, it's always good to have a different set of eyeballs on it. And I think one of the challenges I had when I started off was I build an assessment, I do all my analysis, whether it was right or wrong, and I kind of formulate a picture about what I think things are going to look like. And the more eyeballs you have on a subject or a chart or an asset class, the clearer your picture may get. And it may actually help you figure out some of the mistakes you were making, which I wish I had early on because I made a lot of mistakes without having guidance from people like you, my friend. So those of you who have the opportunity to jump in those sessions with Scott, I would encourage you to do so. You mentioned you were teaching the other week too. Is this a regular thing? Is it all I'm assuming it's all online, right?
Yeah, it's all online. I haven't taught an on-location class since May of 2019. I made my desires known that I don't wish to travel anymore, and that actually worked out a great deal in my favor this year because it took me a little bit of time to get used to working from home and not having that regular daily interaction with other people other than friends and family. And so that adjustment that everybody else went through at the beginning of the year when lockdown happened and everybody had to start working from home, I had already had that routine down. So it was an easy transition, but I'm sitting here sitting behind my 6 monitors and my miniature sound booth that we've set up with microphones and monitoring headphone and little styrofoam surrounding thing to block out any background noise to, just make sure that I'm offering the students the best experience they could possibly have online.
And he does this all, folks, all from a wonderful set of flannel SpongeBob SquarePants pajamas.
I'm actually right now I'm wearing a hoodie that I got from a hot chocolate run in Chicago last November. It was funny. So we went up there. It was a hot chocolate. Yeah, so it was really a lot of fun. It was a quarter marathon that we ran, so just over 9 miles, and I think that was the case, or 15K rather, right? So it was a 15K, so just over 9 miles. But at the end of the race, they serve you with hot chocolate and marshmallows, and it was a lot of fun. But it was super duper cold that day. And but they give you this really cool hoodie, and it's worked out for me quite nicely here because my where my desk and my chair is, it's underneath the vent, so I can get pretty cold throughout the day, and it just helps me to keep comfortable.
I'll make sure to send you some hot chocolate for the holidays so you can reminisce. Scott, awesome. Well, thank you so much. I always appreciate you coming on. I'm going to keep bugging you, so maybe we get you on, once every month and a half or so. I like the BECC reports. I like the perspectives and looking at all these different asset classes, and you certainly bring a lot of great perspective. So thank you so much for joining us today.
Thanks so much for having me. It's always a pleasure.
Yep. All right. Well, thanks, Scott. I'll talk to you soon, my friend. It's not even close to Thanksgiving, but I'll probably talk to you before Thanksgiving. But if not, have a great Thanksgiving.
Sounds good. You too.
Everybody take care. Guys, that was Scott McCormick. I worked with Scott a lot at Online Trading Academy, built a ton of content with him. He's still with Online Trading Academy doing the daily market overview, as many of you have read or have been a part of that, I'm sure. I would encourage more of you to participate. He just really has a great read on markets and relationships between asset classes. But also, you mentioned there's a rotation of daily market overviews, going to different instructors like Bashir Chaya or Brandon Wendell, Brock Pierce. There's a lot of great people that are helping out to build out these products and services. So, I heard the complaint that, all the great people have left from Online Trading Academy. No, not at all. Certainly some people have left. Some people have gone to do their own things. Some people, I'll be honest, I'm downright glad they left. Only I won't mention all the names, but one of them. But other people, I'm extremely happy that they're still there because they're the core and they bring some of the best value to the program. People like Scott McCormick, Brandon Wendell, and Bashir Chai. These guys are just phenomenal. Brock Pierce as well. All right, let me go into a little bit about today. Here's what we had cooking today. I just wanted to show this because for me, when I did the Monday Market Must Know, the cannabis stocks were a big focal point for today. They certainly started to show a nice rally last week. Well, notice those top three. You've got CGC, which is Canopy Growth, and notice their earnings beat. They were expected to lose 23 cents per share. They came out with a 16 cent profit. That's phenomenal. It's 169% surprise. Nice work, Canopy. Aurora, on the other hand, just to go in the opposite direction. Big loser with regards to earnings. Almost, they were supposed to come out negative 24 cents, come out negative 64. And then Tilray, also missing, but just slightly. And of course, because of all the weed growth, McDonald's was doing rather well. I want to show those charts here just because when you look at these numbers, it's hard to make a play as to how they're going to move. So let's look at CGC. Look at the chart on CGC. So, very similar to the market, right? We had a huge gap up today. It still finished the day up 3.8%, which is great, but it gave back a lot of those gains. You can see really the past couple of weeks, or past month, has been beautiful for CGC. ACB, there's your Aurora. Also showing some great move, although it's got a long way to go to get back to those highs that we saw back in May. But nonetheless, it moved from, what were we 4 days ago? 4 days ago, we closed at $4.44, right about there. We were over 14 today on their earnings announcement. So even though they missed earnings by significantly, they had a big pop up. As they say, the rising tide floats all boats. Now, let me just change this over to a 5-minute time frame so you guys can see what's going on in the after hours. All right, so you got no real movement there in ABC, CGC. Nope, nothing really in the after hours. And then we had TLRY. Tilray was your final one there. Again, they were looking pretty good on the overall daily chart setup, but gave it, kind of gave back most of their gains as some of the equity markets have done. Anyway, wanted to show that one there. GD, Tilly's still there. Tilly is definitely still there. And I would say she's probably one of the top ones. She's just out of Kansas City, and I think she just did some certification for online stuff because all the instructors have to go through a certification program. So hopefully she'll be teaching some online stuff soon because Tilly is downright awesome. All right, so that was your cannabis companies that reported earnings today. I thought it would be noteworthy. I didn't look at the McDonald's chart. Here's and there's really nothing earnings-wise that's critical tomorrow. Really no biggies. If I'm not mistaken, you have Rocket Companies and D.H. Horton. That's about it reporting tomorrow. Now, here is stuff that's interesting for tomorrow. This is the economic calendar. A lot of stuff happening for the U.S. You have NFIB Small Business Index, JOLTS job openings, TIP economic optimism, and several members of the FOMC, including Kaplan, Quarles, and Brainerd, all speaking. And then we have the 10-year auction. You probably saw it today. Big spike up in the 10-year. I mean, it was up 16% today on the yield on the 10-year. This goes back to what we were talking about with Bill Addis. He mentioned the steepening curve, and I think that's noteworthy here because, as I mentioned in Monday Market Must Knows, if you guys saw that, you're seeing a real big move up in the yield, which means that the the cost of capital, even though it's historically low, it's still getting more and more expensive, and that could start to, at some point, choke out the economy. Now, that's not, something that's going to happen this week or next week. That's like a, multiple year thing. But as rates rise, starts to slow it down, and those rates will probably continue because how are you going to service all this debt, Treasury? You got to sell more bonds, right? You got to sell it. That drives prices down. In order to get people to buy them, yields got to go up, and that's what we're happening. All right, you wanted me to look at Beyond Meat. All right. Yeah, I know McDonald's coming out with their own version of Beyond Meat, doing their own thing. How long does it take for them to come out with this? I think it said 2021. Like, you got to wait another year for them to come up with a soybean patty? Come on already, McDonald's. You're still bringing back the damn McRib, but you won't make a soybean patty? Let's go MCD. So here's your McDonald's. Nope. I'm just going to, how about MCD, not NCD? There's your McDonald's today. A big gap up, and then just gave it all away. I mean, these were some pretty aggressive sell-offs today in the equity markets. McDonald's really closing that one fast. Brian says, do all gaps close? No. There's nothing that you can say definitively like that everything always closes. To me, and this is what my mentor told me as well, he goes, there's still gaps on some charts that will never fill. We were looking back in the day. There's gaps on Amazon that will never fill. I don't think there's any possible chance it could ever be filled. However, there is a magnetism towards price, and I do believe that most gaps do fill. So in my strategy, in my tactic, in my trade plan, I have an approach to trading gaps, and I, if I can see it start to fill, I'll make trades based off that. But they don't always fill. Yeah, McRib was the original mystery meat. What a gross. It's so funny. I used to get them when I was a kid. Like, you'd be excited when McRib came around. Somebody made a meme and said McRib's like the deadbeat dad. They're really not good for anything, and when they finally do come around, you're excited to see them, but then you're disappointed because you're like, well, this thing sucks. Anyway, sorry, bad humor. All right, let's. You want a Beyond Meat? Let's go BYND. Here's your Beyond Meat. I didn't even see them reporting earnings today. I didn't even see them on the list for earnings today. You could almost have said that the writing was on the wall or something was priced in given that huge sell-off from mid-October. Now, I don't really follow Beyond Meat. I think you guys remember back in the day I was going, short it, you're going to have more competition for them. And that's part of probably what happened today is McDonald's saying they'll be competing. You have other companies all throwing out their, meatless meats, which seems weird, kind of an oxymoron. Anyway. Okay, there was one other question I want to get to, which was from Koja. He's not here today, so unfortunately I don't think Koja's going to get to see the answer to his question. Holy cow, I didn't realize it was that late. I'll go through this quick because I can't give Big Ed the satisfaction of another hourly show. He says, why is there always slippage when I get stopped out? And there is no slippage when the price hits the target, even though the volatility is super high when I hit my target. He says, I use TradeStation, and the setup would be this. Auto limit stop, attach one stop loss and one target. Okay. Tasty, yes. Here's the reason, Koja. For your stop loss on a position, you're using a stop market. You should really never use a stop limit. There are ways that you can use a stop limit, but honestly, the whole point of a stop loss is to get you out, right? You don't want to be in that trade anymore. So what happens is something may be moving quickly, and if it does go through your stop, it's going to fill you at the best market price, therefore you're going to get slippage. When you're doing a target, you're using a limit order. You're saying, if it gets to this price, I want to sell it for X price. And nothing lower. So what will happen is you're probably going to get fixed at that lowest price. It's because their limit versus market orders is pretty much. I know, I totally did Yoda. That was. I don't watch The Simpsons enough to be able to do the Bart or the Homer Simpson one. I'll study it for you, Big Ab, so I can get. Oh, there you are, Koja. Yeah, when you're in a trade and something hits your trigger for the target, it's obviously going to convert that to a limit order, right? And you're saying if it rallies up to this price, I want to sell it at this price, but no lower. And you're thinking that if it rallies back up, it might get you a better price. Probably not. Keep in mind, orders are sold. So a lot of times these orders are sold to different institutions. So, it's not going directly to the exchange. Someone may have paid, I don't know the case of TradeStation, but some for E-Trade, Ameritrade, Schwab, they may be selling that order flow. And if you sell a limit order to a brokerage firm and you say, I want to get out at $21 if it hits it, and it rips through it and goes to 22, you're out at 21. We got you filled. That's the price you wanted. So you don't generally get price improvement on a limit or a target order like that. The market stop loss is why you're getting slippage. Unfortunately, that's just part of the game. You could do a limit order as a stop loss, but give a grace for like 5 cents worth of slippage. But Oh, you guys are killing me. Anyway, Coach, that's the basic reason, market versus limit orders. And understand that sometimes these orders are going through different exchanges and being sold to different institutions. All right, and as I did, I beat the buzzer. Ha! There you go, Big Ab. That's all you got. All right, guys. I don't think I have a guest for tomorrow. I do not think I do. I'm still gonna try to find one, but I'm gonna hopefully have a guest for tomorrow's show. If there's something you guys want me to cover, do me a favor. You can send it on in at TraderMerlin.com. I think I even have my stupid little fire image here, which my friend gives me a hard time about every time I put it up there. She looks so cheesy. Yeah, you know what? I built it all, so who cares? So that's it. We got no guest tomorrow. I might have one. Hopefully we will. If not, I'll be going through a bunch of listener questions and evaluating the markets. Time permitting, maybe bring up some trades. See, I don't usually like sharing my trades in the program, but maybe we will tomorrow. Today was a pretty damn good day. Hopefully you guys did well. Tomorrow you went into the close with a lot of real negative momentum, so keep your short guns out just in case that momentum persists to the south side. If you like today's show, give me a thumbs up. Not, oh well, send me some feedback at TraderMerlin.com. Until then, everybody, I will see you tomorrow. Take care.